Hello everyone and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer and today we're going to be analyzing Oracle stock. This one came in by request down in the comment section of one of my other videos. If you have a stock you would like me to analyze on the channel, just put it down in the comment section. I will get the ticker on the whiteboard behind me and eventually I will make a video. If it's a stock that's in the S&P 500, I post those on YouTube for free. The rest of them I post on Patreon and in the full Cyclical Investors Club service on Seeking Alpha. Patreon's $5 a month, and if you join there, you can get a big discount to the full service if you ever decide to join there. Those links are down in the description. As always, this isn't individual investing advice. This is just how I personally analyze stocks. So let's go into Oracle. This one was an interesting one for a reason that I'll talk about in just a moment. But let's see. Let's start off by, I always start off by looking at the historical earnings cyclicality and the historical earnings pattern, which is the dark green area here. That's the annual earnings per share. And Oracle is mostly going up and to the right over time. It's not very cyclical, as we can see. Let's see if I can shorten this right after just so we can see these individual years here. Let's go a little bit more. So they had a couple down years here in the mid-teens, but for the most part, it has kind of steady earnings growth going all the way back through the last recession. So what that means is if you can kind of project earnings, you can usually roughly project the stock price. We'll probably see that if we look back over time. You can see back here, yeah, it traded at a similar PE than it does right now. It's actually a little higher than it is right now, maybe during the peak a couple weeks ago. Yeah. But over time, the stock price roughly follows this orange line here and roughly follows the green earnings. Now, once we get to COVID, things get a little wonky, just a little bit with the stock price up and down, but it's still gravitating right toward the kind of the center point of, and I think this orange line is a 15 PE over time. So that's over the long run, we can see that the stock price follows the earnings per share until the past couple years when it's gotten just a little bit crazy, but sometimes, I mean, not super crazy, not compared to the rest of the market, but you can see we've gotten a little more volatility in here. But generally speaking, if you can figure out where earnings are going to be 10 years from now, you can pretty much figure out where the stock price is going to be. So what we want to do, the way I do this usually is I take the past earnings trend and I just extrapolate it out into the future while controlling for a few things that can alter kind of those earnings, or keeping an eye out for obvious changes if earnings are slowing down and maybe going to go too slow or negative. So, but if those things aren't there, then basically I just assume that this trend is going to continue, and then I use that to value the stock. So the tricky thing here with Oracle is this green area and this number down here are earnings per share. And over the past 10 years, they've bought back a lot of stock. They bought back about, I have to widen this fast graph to 13. I think it's, yeah, so that would be about 10 years to the current day. They've bought back about 40% of the company over this time. So what that does is, and there's nothing wrong with that. I don't know, do they? Yeah, they do pay a dividend as well, a small one. There's nothing wrong with that, but what investors need to understand is if you're thinking about this from the perspective of somebody who owns the business and is going to take those earnings out of the company and just like spend them, like if you own this business, and not buy back shares, because what happens is when you buy back shares, the share count goes down, and that inflates the earnings per share. So this earnings growth rate over this time period on fast graphs is 7 to 8%, okay? But when I control for those buybacks, because they're so huge, the earnings growth rate goes down a lot. It goes down to about 3%. after my adjustments. And this is a 3-year revenue. Usually you can look at revenues to kind of adjust for that, to kind of confirm the adjustments to the shares. Because if you just look at revenues, that doesn't take into account shares. This is a 3-year revenue number, so you're looking at like maybe 8% per year growth in revenue. But this was actually unusual because revenue grew a lot during COVID when it didn't beforehand. But even if you go back 10 years and you take 10 years worth of kind of average revenue growth, it's a lot closer to that 3% number than it is to the more recent 10%. So I think this number is probably about right. And we do have some evidence of that recently because they stopped buying back shares for the past 2 years. So in 2022 and 2023, they didn't buy back any shares. They actually issued a little bit of shares. So that may have contributed to some of the more fluctuation in the stock price too. But we can see when they're not buying back shares, earnings growth is 5% and 4%. So this is really what the business is actually growing when the company isn't buying back its own shares. And what that to me says is if it's a stock and it's only growing 3%, that's at the rate of inflation basically. So really they haven't grown the actual business in real terms for the past 10 years or so. We had a little bit of spurt of growth with COVID, but again, we also had higher inflation. So if you adjust that for inflation, we're basically looking at a no growth company. So this gets into investment philosophy a little bit. For me, the reason I own stocks is because if you take inflation, future inflation, as an unknown, a good business, even though it is unknown, will be able to pass on that inflation ultimately to their customers with pricing power. So a good business is just a natural hedge against any inflation. And if you have a business that hasn't shown that it can grow any fast, I mean, it's adequate if you're as a bond proxy, basically, but it's not growing any faster than inflation. So for me, I want usually this to be at least over 4%, this earnings growth rate. So it's a little slow in that regard. Second, if you do take this earnings growth rate, the PE ratio of 19 that it trades at now, or almost 19, is quite high for this earnings growth. So if you create a 10-year CAGR like I do on all these, you only get a 4% 10-year expected CAGR because you're just paying too much. Like normally, a stock that isn't buying back shares, that isn't growing faster than inflation, you would want it to be paying out like an 8% dividend yield. So, and they only have like a 1.5% dividend yield. So that would be historically the earnings. If you get the same rate you've gotten historically, is not a very good buy right now. Now the question mark is, I do know that they made some acquisitions and it looks like they're going more for growth now. And that's probably the reason they stopped buying back shares. So they're investing more for the future now. And I forget exactly what it was they were buying. I just saw a couple of things in the news. And I didn't re-look them up. But I do know that they are actually going out and trying to get growth. I think they're trying to do some AI things. So if that works out, then they'll probably do better. But it's really hard to know. And it's especially hard to know, I think, with a company as big as Oracle because, okay, maybe that part of the business does well, but is it going to move the needle for their business, or are they just going to end up kind of keeping business that maybe they otherwise might have lost? Who knows? I'm not smart enough to like figure that out. So for me, if I'm going to invest in growth in technology, I want to get like a more pure play with a smaller business. or have a bigger business like Google that's growing anyway, right? That's growing at a reasonable rate anyway, and they might get a bonus, right? Or Microsoft or whatever. So that's generally my thinking on it. It's not so much a call on whether the moves they're making now are going to be successful or not. They might. I'm saying I don't know that. I'm going to take the 80% chance that historical trend keeps going over the next medium term 5 years. And so for me, this would be an avoid. I don't know for sure if it would be a sell. I mean, I might not sell it unless I saw another opportunity that was attractive and I didn't have any cash. It's probably, as you can see, it's been pretty steady. Now we had a little bit of volatility now with their change in strategy. Basically, you can see it kind of happened at the same time. But it's not like super risky or anything, I don't think. So I'm not sure it'd be like a hardcore sell, but because you might get lucky and they might actually, I mean, the growth might work. So it's possible it could work, but it's just too hard for me to kind of judge and know what that's going to happen. It's not really the type of bet that I want to place on. I mean, it's a big company, right? It's almost $300 billion. So, all right, that's my thoughts on Oracle. Basically, overvalued, I would say. For my particular style, I would even lean more toward the sell, but it's not necessarily like a hardcore, clearly obvious that they're going to fail or that they're going downhill. It's more of just like a, if I owned it, I'd be looking for something that had better prospects type of a thing. All right, if you found this useful, hit the subscribe button and the like button, and I'll see everybody in the next video.